Welcome to StockMarketPlanning.com. I'm going to conclude this part of the monthly chart. What I want you to know is that we have room to go higher if they can create the monthly buy signal. And the amount of exuberance that will get put in here, because every move has an exuberance. And when I show you the 10-year history of these exuberant moves, is that they fell. And the 10-year history is that we had long-term consolidations. Superhighway to inflation was back over here during these years in the 70s, because they were. And basically, I'll just show you some snapshots of 72. We went down, we went up, we went down, then we went sideways for a number of years. And then we went up. And of course, the world was different. But whenever we had these big cycles up, they failed. And what I'm trying to show you is I want people to be very cautious. If you've been involved in a market or you haven't been involved in a market, don't get triggered into the top of the market. They're trying to get money off of the sideline. What happens in another bubble versus where the true economic picture is that we're creating another bubble within the move. And this is leg two. This is leg one of the bottom. This is leg two, and if we get a monthly buy signal, we can go all the way up here. And a total V. This is just a shorter V. A total V with a buy signal would not be abnormal to come up to these V's. These are just lower V's. That's a full V to the correction up here. But V's based on where a V-shaped pattern is that everybody is banking that that's going to happen. I don't see that happening because I don't. This is part two of that V, and this is the upcoming one right here. So let me take out the trend lines. Basically, what I have here is this is the top to the bottom, and this is the bigger part of a total V on the top end. The secondary part is where the deterioration started in 2008 down, and this trend line goes right to that bottom, and it comes right up here. That's the second part of the V. Top V, lower high to the V, and the third lower high is where we're coming right now, and that's where half of this bar to that bottom goes, and that's where this shorter trend line right here goes right to this part of the V. V1, V number 2, V number 3. A monthly buy signal can get you up to V number 2. And you can have a continuation in these mathematical exuberances. It happened in the 1930s twice, and each time failed. And in the 1930s, when we were at depression levels and markets walked the tape up, what's going to happen on the Dow is there's no more short interest. When everyone was short, they bought back the short interest on the indexes and we grinded higher. Then we had buying as well, and we've had exuberance. But as we move higher within the V, that means that there is less short interest to hold the markets up at support. So that when we do start to correct, you don't have a lot of short interest in the market. It's all to the buy side volume. And what gives market support is short interest in the indexes. So you come down, people buy back their short, and you bounce. That's how things get support. The higher that we walk in the V, the less support that this Dow will have, and all of the other indexes as well. Same rule applies. So basically, a monthly buy signal can take you through that area up to this area on the Dow. And remember, the Dow was only 30 stocks. And it's the biggest gimmick in history is that people psychologically see, wow, the Dow is going higher, so now everything's got to go higher. And then that thought pattern turns into exuberance. And what happens is that the majority of the crowd keeps going higher and higher until they're all in. And one of these events happen again. And what I'm telling people, if you watch the tape, and whether it's another 6 months from now or 9 months or into 2011, you'll be able to go back and you'll see how true of what I have said is. I would never lose this videotape, nor would I ever lose the realities of what I'm telling you about markets. If you want to learn a lot more, you can do this. And stockmarketfunding.com will guide you through what exuberant parts were failures, and then the exuberance happen before the failures come in. And basically, what you don't want to do is you don't want to get caught in the exuberance. If we get to the monthly buy signal, and as it goes higher to these lower V shape, V1, V2, top V, full V recovery up here. But remember that the full V recovery will also have one of these back down. That's the part you don't want to get caught in. Now, I will say on this tape one more time is that what I want you to be aware of is the part that I want you to be aware of is a lot of money is coming off the sideline out of around the world is coming in the U.S. market because the United States market lagged the move. So people are going to chase performance, which will also provide that upper one or that one there. Right now on a monthly chart, even if you were in a rip-roaring bull economy or a rip-roaring bull market, is that you are getting up here at 89.03 on a percent DS, which is an indicator that establishes weekly, monthly, and daily overbought cycles. Basically, we can go higher in here, but the higher we go, the bigger the correction that we're going to get. Because what's going to happen is you can only go so high here before that profit taking is going to come in the market. And longer term, though, there is a third leg to all of the Dow and all of the indexes. And the third leg is, this is leg 1, this is leg 2. The third leg would be that cycle down. Wherever we end up in here, you're going to have another third leg to the first leg down. First leg down, first leg up, third leg will come. And basically, down here was the time to buy. These monthly, you can see what happens when you get these buy signals. They go, that was an expansionary part of the economy. I don't see that one being like this. And what I'm saying is, the higher that we go overbought on the monthly level, and on the weekly level right here, they've gotten it to that 200-week moving average, and they're trying to push it through. On the weekly level chart, we're at 93.85. And we look at that exuberant part of just the opposite. When we were down here at the bottom buying, we were 12.03. That meant we were deeply oversold. Here on the weekly, though, just the opposite of the move of this pendulum is that this is breakout 2 of 2010, which is leg 2 of the original leg off the bottom. However, down here, we're overbought on the weekly. Stay tuned. Come to stockmarketfunding.com. We're here to help you. Don't get caught in exuberance, and understand when to pull out of the market, when to buy the market, when to sell the market.